Hello and welcome to this live interaction on Bloomberg Quint. We're speaking with a very well-known investment strategist, Morgan Stanley's Ruchir Sharma. Ruchir's just written a fabulous book, The Rise and Fall of Nations, in which he has put down, if I may call them, his own 10 commandments or ways of measuring, the kind of challenges, the kind of opportunities that nations face. And we'll talk about the book in just a few minutes from now. But first I'm going to ask him to sort of decode for us where we are in the global economy. Ruchir, thank you so much for speaking to Bloomberg Quint.
All right, thanks.
I'm going to start by mentioning some of the data you brought up in the book itself, right? For instance, you said capital flows hit about 9 trillion in 2007. At that time, it was about 16% of the global economy. They've come down to about 1.2 trillion, 1980 levels. That diminishment in capital flows is quite incredible. Do you expect that they will ever go back anywhere close to the levels in the big financial boom, or are we doomed to live at these levels for a long time now?
Well, I don't know whether we're doomed, but I think that this is part of this entire section that I've covered in the book about deglobalization. And this is one key aspect of it, that you have capital flows which have collapsed. You have trade flows which have collapsed. In fact, for the first time now, outside of a recession, trade flows are actually, trade volumes are actually contracting this year.
Yes.
And these are huge shifts taking place. And then we have a rise in protectionism. That if the WTO and other organizations tabulate protectionist measures, and if you look at it, the rise in protectionist measures which has taken place in the last few years has been quite unprecedented. And India has been at the forefront of this. The country that has taken the maximum protectionist measures this decade, in fact, has been India. So I'd say that this is the combination going on, that you got capital flows which have collapsed because banks today are much more reluctant to lend across borders. The main reason capital flows exploded in the 1990s and last decade was that banks were lending a lot beyond their borders. Now banks in Europe and America, for obvious reasons, have become much more risk averse and are just not lending as much. And we pay so much attention to portfolio flows and FDI flows, but cross-border bank flows was really the big chunk of the explosion in capital flows which took place, and a reason why that's collapsed of late. So this is the era of deglobalization. It's not all gloom and doom. There are some ways in which the world is much more interconnected today, thanks to social media, the internet, and also some random figures such as tourism flows and all are at record highs. But in general, the way that we thought of globalization for a generation has really fallen into much harder times now.
Okay, I used that one data point. I'm going to use another one to get started on the conversation about the global economy. You said in the book, as a whole, the world has a bigger debt burden now than it did in 2008. That was one of the critical reasons for why we saw the big global financial crisis. You're now saying that in resolving all the situations that led to the crisis and all the monetary policy measures that we've seen, we've in fact seen that debt balloon since the 2008 levels. Is this not a bad omen?
Yeah, it is, but the key thing here is that how it keeps shifting, which is the fact that the big debt buildup last decade was led by the developed world, the European countries, and of course the United States and the housing bubble.
Right.
Now it is being led by the emerging world, particularly China. And just see as to what's happened in China. There's one key statistic that tells you, which is that today it's taking $6 of debt to create $1 of growth in China. At the peak of the US housing bubble in 2007, 2008, it was taking $3 of debt to create $1 of GDP growth in the United States. So that's the shift, that the risks have moved on, and today it is about China. China is where the debt levels are exploding on the upside, and it just is that the entire debt there is internally held. There's no one out there to keep coming and calling for the debt. But the fact is that the situation has changed, but yes, it is a bit worrisome for me that the debt levels continue to go up, but China now is at the forefront of the debt build-up.
Okay, I'm going to come back to China in just a bit because you've written about it extensively in the book. But the third data point I wanted to bring up to you is not in your book. This is actually from Fitch Ratings. I think the Financial Times had an article talking about this the other day. $11.7 trillion of sovereign debt now carries negative nominal interest rates, right? It's a shocking number. It was apparently up by just 1.3 trillion in the last month itself. I think that data goes on to say about 2.6 trillion is in long-term bonds, and that, only about 2 trillion bonds carry an interest rate of maybe 2% and more, right? So what does this mean for where we are in the global economy? We were trying to fix a problem in 2007, 2008. And I'm not sure whether we've fixed it or we've added to the problem or pushed the can down the road.
Yeah, this is a very unusual experiment because I've looked at inflation data going back the last 400-500 years, and we've had periods of deflation in the global economy, but we've never had negative interest rates before.
Yeah.
So this is very unique from that standpoint. But I think that the entire thing here is that this is also partly reflective of just how weak economic activity is everywhere. There's not a single region in the world today where economic growth is anywhere close to where it was in before the 2007 crisis. So therefore the whole book I divide into two segments, the so-called BC and AC, which is before crisis and after crisis.
Sure.
So this is reflective of how weak the global economy is, and the fact that central banks are also sort of running out of ideas and trying these new experiments now which aren't paying off that well. So I think this is more reflective of the weakness in the global economy than anything else out here, and the fact that there's such a rush for safety and you want to sort of be in whatever safe assets you can.
But there are consequences of all of this, right? Lower capital flows, higher debt burdens, negative interest rate debt. Are things going to get better before they get worse? Are they going to get worse before they get better? Or is it, as you say in your book, we're in for an era of very slow growth, or slow growth rather, not very slow growth. And that means that the kind of growth that we experienced when we were in our 20s and 30s in, about 10 years ago, 15 years ago, that probably will never ever come back.
Yeah, but I'm in that camp, which is that the global economy grew at about 3.5% or so for a lot of that period that you're talking about, and now we seem to be in this 2.5% range. That's a huge come down. In fact, someone did a back of the envelope calculation and said that the global economy was still growing at its old trend rate. It would be about $6 to $7 trillion larger today than where it is today. So that's the huge loss. But there's one very important point which I think is really underestimated, that we all want to look for structural reasons as to why this has happened, and we point to government policy, too much debt, and also factors such as too much regulation, etc. And like all that stuff is quite legitimate. But there's one really underappreciated factor as to why the global economy is much slower today, which is the world's population growth rate is much slower today. There are two drivers of economic growth. It's the world's population growth rate, or the labor force growth rate, and productivity. So a lot of focus on productivity, not enough on the fact that the global economy's population now is growing at a much slower rate than it used to. In fact, there are more than 30 countries in the world today with a negative increase in their working age population, led by China. So that's a huge swing which is taking place. And that's the main reason I think why the global economy today appears to be much weaker than it used to be, because the growth rates, you just can't get the same growth rates when so many countries in the world are seeing a shrinkage in their working age population.
I know you refer to it as the 2% pace test, I think, in your book. And I did have a question on whether, in order to have the growth that we are all talking about, or a return to the growth that we all experienced, whether that kind of increase in population is sustainable, just from the point of view of the air we breathe, the water we use. But I'll get to that in just a bit. Era of slower growth. The commodity markets seem to have factored that in, though you might say that they move in cycles, so they were bound to fall. But have the equity markets globally actually recognized what you're talking about? Have they got it right? Because the beginning of this year did seem like, yes, we were adjusting to the fact that that kind of growth will never ever come back. But there's been a great recovery since then. And so I'm not sure whether markets are reading it right, or are they so hopped up on liquidity that they can't read anything right anymore?
No, I mean, I agree with your latter point, which is the fact that asset prices across the world today are very high given where the global economy is. And a lot of the excess liquidity has gone into financial engineering, whether it's share buybacks and other things, rather than in sort of lifting economic activity. So there is definitely like an element of that. And the single most important decision which sort of rescued the markets this year, including China, was when the Fed in late Feb basically backed off
from the rate hike.
Exactly, from any rate hike, and turned much more dovish. So the role that liquidity has been playing in this is extremely important. Having said that, global equity markets for the last 2 years have really been stuck in a range. They haven't done much. So, they go up and down, but they've broadly been stuck in a range.
But even at this point, they're expensive, they're overvalued?
Yeah, I mean, in terms of compared to their long-term earnings and stuff, they're mostly on the expensive side. Now, some emerging markets have got really beaten down and appear relatively cheap.
Sure.
But in general, asset prices today are relatively high, and liquidity is and very cheap money is the main reason why asset prices are so high. And that also is an issue that I've touched upon in the book, that's also leading to greater income inequality, because the people who own these assets, which have gone up so much, stocks, bonds, even property, tend to be the rich people.
Yeah, it's the 1%.
Exactly. So they've benefited much more from these easy money policies than the rest of the public.
So you've just painted I know you didn't say it's not all doom and gloom,
right,
but you've painted a fairly dismal picture of what the global economy is going to look like in the years to come, and you've said markets are very expensive, or markets are overvalued at this point in time. So you are in a sense saying that we should be prepared for a correction in asset prices in the years to come. At some point, we're going to have to pay for all the sins that led to 2007-8, and then someone's going to have to pay for all the monetary policy easing that's happened in the last 10 years.
Or it could just be like a low return world, because money is easy. I don't see money getting sort of expensive anytime soon.
What do you call what is a low return in your book?
We've done these calculations. We don't think that there's any asset class out there which on an annualized basis is going to yield double-digit returns in the next 5 years or so. And you have places like US and stuff where I think we'll be lucky to get 2 to 3% type of returns every year for the next 5 years. So this is the consequence of the fact that asset prices have gone up so much. Having said that, there'll always be places in the world where you think you could do relatively better. So, and my entire concept, therefore, like in the book, is to come up with those countries where growth can be relatively high, because our work really shows that if you get that argument correct, that you end up identifying those countries where growth is relatively high, you will make outsized returns. So I think that's really the focus of the effort here.
Okay, I'll get to the countries which you think will do better than others, but I do want to try and understand what all of this means for India, right? You have made this point, I think, more than 2 times in your book, that countries do return to their, sort of their mean or their average growth rate. You've also said, and I think in the book you've said, for emerging countries, this is in your last chapter, you've said good solid growth in the future is anything at about 5% or more.
Yeah.
India continues with its long tradition of confounding optimists and pessimists. India is probably growing at a rate of between 5 to 6%, less than what the government claims.
Right.
What do you make of, or how do you assess India's growth currently and the growth opportunity in the years to come?
Yeah, no, I think that, the first point is very important. There's a new math of economic success out there, which is the fact that the entire global economy is weaker. So to judge how a country is doing by the old benchmarks is not even right anymore. Like in the last decade, as I said, at the peak of the boom in 2007, there were more than 60 countries in the world which were growing at a pace of more than 7%. And that was my point about India back then, that we were underappreciating how much the global tailwinds were carrying India up.
Of course, yeah.
And today it's possible that we are, got caught up in this anchoring bias, where we're comparing ourselves to last decade and want to show that we're growing at 7 to 8% or a similar growth rate to think that things are as good as etc. No,
What is it? You doubt the data, you doubt the integrity of the data, you doubt the collection, the base years.
No, when you changed the methodology last year, I immediately came out at that point in time and said there's something wrong with this methodology, and it's amazing that we are more than a year past that, and a growing number of people have come to that conclusion, that there's something wrong with this methodology, whether it's something as technical as using the wrong GDP deflator, or something that you're doing to gross up the numbers when you're calculating the manufacturing sectors, or the number of companies contributing out there. There's something wrong which doesn't feel about it. And we get all sorts of typically Indian exotic explanations as to what's the matter, that commodity prices have fallen, input prices are falling. So all those technical definitions as to why it's possible to get higher growth rates despite the fact that you have these slowdown numbers and stuff. The problem is I don't hear these arguments in any other part of the world. I only get to hear these very sort of unique arguments here, even though commodity prices are falling everywhere. So I think that in India's case, it is sheer incompetence. I don't think it's about fudging the data. That's not something which I've ever said about India. It's just sheer incompetence, as I said in India's case, that nobody questioned that whatever the limitations of the GDP numbers were before they changed it in February of 2015, no one questioned the credibility of the numbers. They may have questioned that it's not capturing it, but no one questioned it. The new methodology has been subject to question from day one, and I was among the first people who said that. Okay. And since then, so I mean, there's a sort of Indian line that I say there, that if in India it ain't broke, you fix it until it is.
Okay.
Right? That we have tried to fix this problem by thinking we need to capture it better, but we've actually made things worse in terms of credibility.
Yeah, okay. So you're saying we're currently growing at 5 to 6%.
Yeah, and I think that's not a bad outcome.
No, I'm not suggesting it is either. What I'm
right.
trying to understand is, what happens from here on, and I'll get to why I'm trying to get that. Good solid growth, you said, should be at about 5% or more for an emerging country like India. You said we will revert to our mean, which I'm assuming is 5% according to you, so we are there already. I'm just wondering, is there a downside to growth for India here on?
Well, there's a downside to growth if something happens to the global economy, and I think that, in terms of, otherwise I think that India can sort of steadily outperform and steadily do okay, which is like, I think the current growth rate, the best guess is about 5 to 6%. It's not a science. This is something that we're sort of like estimating out here. But the key thing here really is the fact that we have to accept that growth is going to be lower everywhere, and even in India's case, growth is lower in terms of what it used to be. Now the entire question is that, can it get lower from here? Possibly not. I still see a path of steady acceleration from here in terms of what's going on. But I think that the big risk to the Indian economy is again from China. Because look at what's happened in the aftermath of the Brexit. Basically, this panic has subsided very quickly.
Yeah, it has.
That you had, and markets almost back to where they were before the Brexit vote. In contrast, see what happened to sentiment and the economy when China had its problems in August last year and then again in January, February this year. That really led to a much wider sense of panic and fear in the economy and in the marketplace. So the risks to India are from the east, not from the west. Okay. I think that's really how we need to look at the situation.
Okay, in which case then I should bring up my China question here, because I think when you spoke of China and the kiss of death, and you've said something about, and I wrote this down, you end in that chapter by saying every extreme credit binge has resulted in slumping economic growth, often accompanied by a financial crisis.
Right.
Should we prepare for a financial crisis in China? Because we've seen the credit binge, we've seen the slump in economic growth. Is that the next thing to happen, a financial crisis in China?
Well, if they keep tacking on debt at this pace, it's entirely possible. The only thing which prevents China from having a crisis is the fact that they said that the debt is internally owned.
Sure.
So there's nobody who comes there calling for the debt. There are no foreigners knocking at the door saying we want our debt back. And even internally, because the state is so involved in it that the state can direct that, where does the debt go, and you don't call for the debt. Now, crisis is what we're really afraid of, because it's a terrible thing to happen. But sometimes, as we saw, like in the case of the United States, it also ends up clearing the system, which is that you have foreclosures, you write off the bad debt, and then you move on. Or you can have the case of Japan, or even the case here in China, where the debt just sits on the books for a long period of time and chokes economic growth. And you don't get a recovery which is strong.
Is that what's going to happen?
I think so.
I'm so sorry. I keep asking you to forecast something, but
no,
I think that's the big fear out there, right?
Are
you anticipating more likely than not a financial crisis in China?
Yeah, my base case in China has always been that this is like a slow motion train wreck. It's not a train wreck. It's not as if it's going to hit you one day and there'll be a crisis there. But this is like a slow motion thing, as I call it in the book. This is like a ping pong ball bouncing down the stairs. It's not a ball which is just crashing. And what that really means is that growth has been moving down, and every time there is a major slowdown, they put in more stimulus. So for a while, growth perks up, and then it reverts back down again. So that's the pattern I expect to see in China.
Nice
if you ask
visual analogy, for all of us who work in broadcast.
Right.
Okay, I'm going to go back to India, but I think I'm going to bunch a few top points, because we're also very short of time right now, and I know you've got several other engagements. I'm looking at the 10 commandments in your book, from the India point of view. You've spoken of how even the most promising reformers at some point tend to grow stale and arrogant. Putin, at one point, the pragmatist, Putin, the populist.
Yes.
You haven't written as much about Narendra Modi and his government in the book. There are several references to India, some references to the Manmohan Singh government, and maybe one or two references to Mr. Modi, especially when you talk about RAGHURAM RAJAN and the fight against inflation. Just curious to know, how do you assess what he has been, or who he has been as a prime minister and an administrator? Pragmatist, statist, reformist?
Well, I think that 2 points here. I think what has surprised me about Modi so far is that most people sort of thought of him as a very authoritarian leader with very firm convictions and very decisive. At least on the economic front, we haven't seen evidence of that, which is that the reforms that we've seen over the last couple of years have still very much been incremental in nature and tentative. And I'm a bit surprised, and this is something which I've written about in the book quite extensively, as to how little has been done to solve the public sector problems of India. The fact that India today has the largest share of public sector banks of any country, that 70% of lending in India is done by public sector banks, which is twice the emerging market average, and maybe save for a North Korea, there's no country with more involvement of the state in the banking sector, is a pretty sort of shocking statistic to me. So the fact is that, I've been surprised by how incremental the reform approach have been of someone who we all thought was very decisive, and the risk was that he would sort of, break too much China rather than sort of go about tentatively. At least on the economic front, it has been quite sort of incrementalist in nature. Having said that, I still see this in a global context, which is that populism is on the rise in many countries. So the fact that we're even getting incremental reform in India, I guess for now we'll take it. It just is that in the first 6 to 12 months, so much more was expected given the amount of political capital he had. And now we just have to be sort of make do with the fact that it's going to be incremental reform which is going to happen. And I'm a bit surprised by the fact that he hasn't gone more to withdraw the state from the economy, because the tentacles of the state in the Indian economy run deep, and that I think is a major problem for India.
And you've written about it eloquently in the book. One final question before we close. What did you think of the hounding out of the RBI Governor RAGHURAM Rajan? I use the words very carefully because it did seem like a hounding out. You spoke in your book of the fight against inflation in an entire chapter devoted, I think, on inflation and the need for low inflation to be able to foster growth. And you said Mr. Modi seemed to be backing Raghuram Rajan's, at least when he was elected, Raghuram Rajan's fight against inflation. Do you think that we have now, as a country, lost that fight?
Well, I think there are 2 points here. One, that the lesson is that in government, if you really want to survive, you can't have too large a personality, because that really sort of runs conflict with the way the governments function. That's just a sort of lesson that we've learned from this episode, because I think the problem here was as much about personality as about policy. And the second point that I'll make here is that I had a quote in the book from this meeting I had with the former central bank governor of Malaysia, who put it quite eloquently. He said that good central bankers are like good tea. You only realize their worth when you're in hot water. And I think that's really the issue with Rajan too. Then 2013, when things were really hot, you wanted somebody like him. Today, because things have calmed down, it appears as if there's no sort of major crisis out there, you think he's dispensable. So that's just a sort of ruthless word, which is that you only appreciate people like him when things are hot, not when things are calm.
Ruchir, thank you so much for speaking with us here at Bloomberg Quint. And with that, it's a wrap on this interview. We hope you enjoyed watching it, and do try and get your hands on a copy of The Rise and Fall of Nations.